Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me is Rob Waldner, Chief Fixed Income Strategist at Invesco, to discuss why your time horizon is the key component of investing now and where the shorter term risks may lie. Rob, it's great to have you with us. Welcome to Trade Talks.
Thank you very much, Jill. Thanks for having me here.
Rob, why is time frame key to looking at strategies in this environment and, of course, in any scenario?
Well, time frame is always important as an investor, but now it's more important than ever. The reason is that there's a number of fundamental factors that have been supporting markets, and we think will continue to support markets. The passing of the COVID crisis, the bounce in economies, policy support. But at the same time, valuations are very tight. So we know markets have rallied a lot since the COVID crisis sort of passed, since the peak of the COVID crisis. And so there's not a lot of real obvious opportunities out there. And when valuations are tight, they make assets more subject to volatility going forward. And finally, in the near term, there's quite a few pieces of potential volatility, quite a few sources of potential volatility, both in politics and in terms of policymaking. So, we think that the longer term, it's a very positive environment, but short term, there's some headwinds.
All right, and let's talk a little bit more about the longer term. Of course, you expect a good environment for risk taking. So let's discuss the rationale behind that, considering all the outliers that investors are facing heading into and through Q4, and then we can dive into the shorter term risks in just a moment.
Okay, so let's talk about going into next year. So the balance this going into next year, the environment we think is pretty positive for investors overall. The reason for that is that we are kind of moving through this COVID crisis. So despite the fact that we have a second wave going on in Europe now, and we've had a second wave here in the US that seems to be passing through, the key difference now is that the deaths and the hospitalizations associated with these waves are so much lower than in the first wave. So we really have an environment where it seems like the deaths and the hospitalizations, which really are the most important thing, I think, when we're talking about this disease, are much, much less than they were before. So the headline of number of cases gets a lot of attention, but the deaths are much lower. That could be for any number of reasons. We don't really know, but it could be because we have better testing. It could be because we know how to treat better. It could be the virus is mutating to become less deadly. But nonetheless, the facts are out there. They speak that deaths and hospitalizations so far, we're watching this closely, have not picked up with the cases. So that's a positive, which means going forward, it'll be less of an issue for us. And we've seen the economy bounce back, I think, better than we would have expected. And we certainly see, so the fundamentals are quite positive. Secondly, policymakers have committed to long-term support. Both the Fed has committed to keep rates low for long, and the fiscal policy support that we've gotten has been just tremendous. I mean, we saw earlier this week, we got the household net wealth data from the Fed. U.S. household net wealth at the end of June was at a high, a historic high. So that just shows you part of that's the market, but a large part of that is the fiscal boost that the government put into the economy. So both of those are very strong positives for the longer term.
Right, and as we talk about the short term, and you had mentioned before that we're seeing, wealth grow, but that also means that consumer spending might not be taking place if people are saving those stimulus checks. So, of course, in the short term, what are some of those risks that investors should be thinking about?
Well, short term, we have several key risks right now. Right, one, we are in the midst of a second wave, which in Europe we see increasing cases in Europe, and investors will want to see how that pans out. So if that continues to rise, that will create some nervousness. Two, the U.S. political situation. I think, regardless of how you stand in terms of candidates or parties. The uncertainty here is very high. The possibility of an extended period of uncertainty here around this political process, we think is very high. You can even see already markets are pricing in volatility to extend past election day. So that is a potential headwind, which will make investors quite nervous. And then, the other thing is that policymaking is kind of hitting a bit of a rough patch here. So we don't know whether we'll get this additional fiscal package. It's looking less and less likely we'll get an additional fiscal boost. That the market may disappoint the market. And also, the Fed is having a remarkably tough time communicating its new framework strategy. So we saw in the press conference at the FOMC and a couple other times, there's been some missteps, I think, in communication. We think the policy is clear, that They'll keep rates low until inflation is well above 2%. But they're not doing, they're having some policy communication missteps. And so that's more volatility in the market. And so those things are all there, which when you have relatively tight valuations, that could create volatility going forward.
Well, Rob, with rates as low as they are, central banks are obviously going to keep them lower as well. Investors have been turning to U.S. equities for returns. Now,
Yep.
you have identified potential global opportunities to watch. Tell us about that.
Yeah. So if you take our framework and think about what this means going forward, first of all, the Fed being very, very easy for an extended period of time, and looking to get inflation up means by definition that the Fed will keep real yields very, very low. So right now, real yields across the U.S. yield curve are below -1%, and they've basically committed to doing that. And we think they will get real yields even lower. So in an environment where real yields are going down and inflation expectations are going up, that's very good for real assets. The housing market, other inflation tips, inflation-adjusted bonds, et cetera, should all do well in this kind of environment. So we like all of those things, and indeed, we see the housing markets doing very well, very strong. All the data we get out of the housing market now says the housing market is doing very strong. So those assets that will do well with inflation, which is inflation-linked assets and real assets, should be a good opportunity. Second, EM. So emerging markets have struggled to get the COVID under control, and I think that has made investors nervous about committing capital when they don't know how that is going to pan out. And also, with the pickup in debt in emerging markets, it's made investors somewhat concerned. So when you look actually at portfolio flows, there are big portfolio flows out of EM in the depths of the COVID crisis, and they haven't really returned yet. We think they will return. And so EM is a good opportunity, which has lagged so far. And finally, the third thing I would point investors to is kind of something where you get a bit of safety and a bit of yield at the same time, which is Chinese fixed income, where we know China is a large country, large capital market. It's not well tied to the rest of the global economy. In fact, it's pulling further away. So it's a more diversified investment. And China's 10-year government bonds are about the same level right now as they were at the beginning of the year. So it's one of the few assets where it still provide yield relative to almost all of the global assets. The yields have declined remarkably. So, in a relative value perspective, you can get, over 3% in Chinese government bonds, which, could give you some yield and also give you a bit of a diversification that other assets don't. So those are three opportunities.
All right, Rob, thanks for joining us on Trade Talks.
Thank you, Jill. Thanks for having me.
You got it. And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.